Hello, everyone. This is Dr. Duru from AHA Analytics with the market breadth. You guessed it, the big news, and we got it at the end of the week, last day, trading day of the week. The Supreme Court struck down Trump's tariffs. These are the core tariffs that came with last year's April tariff trauma, drama, and noise. They were declared under an economic emergency. The Supreme Court basically said that that was unconstitutional and that only Congress can declare those emergencies. I think that's basically the sum of it. Now, for any of you who are interested in these things, I highly recommend that you check out some of the clauses in here in the judgment for yourself. They say a lot about how our democracy runs and how it's supposed to run, and then some core key differences of opinion about what the Constitution says about how our democracy is supposed to be run and how much power gets to be placed in the hands of one person in office, the president, basically. So anyway, just don't completely rely on media accounts, or particularly don't rely on what the politicians have to say about it. Check the document out for yourself. It's in the public domain. I'll put a link down in the captions below. All right, so what else do we have? Main thing that I see coming up this week is the State of the Union address. I suspect that the market's going to hold up going into that address and out of it. We know the president likes to keep the stock market propped up. Now, the only, I think, excitement that could happen is looking for stocks that have suspicious ahead of the State of the Union. You know what that means, particularly for you conspiratorial folks. And then if there's anything that's said that impacts certain stocks or industries, we should see some short-term movements, again, either up or down, but I don't expect those movements to last. If you follow stock market action before or after State of the Union addresses, they tend to be very temporary because there's just a lot of platitudes that usually presidents will throw out there in the State of the Union, and very rarely do the things that show up in there become policy because it takes time and Congress's cooperation. So anyway, it was mostly a yawner of the week. There was thrashing last week. That was the theme. I said the market is just thrashing. There was just more thrashing this week. It was a much calmer type of thrashing, but I still suspect something as big is on the way, whether it's a breakdown or a big breakout. All right, let's go ahead and check out the indices, market breadth, and some key charts that tell the story of the week, and really mostly of the end of the week. All right, let's check it out. Actually, before I dive into the stock charts, there was also an economic release, actually an inflation release on Friday that I don't think the market paid much attention to because of the tariff news, which is that PCE, which is the Federal Reserve's preferred inflation indicator, this is the personal consumption expenditures, came in hot. And I can't really zoom in here, but you can see this black line, that's the PCE, and the green line is the core. These are both core, which means it's food and energy have been stripped out of these inflation measures. And something important happened here. And let me just use Zoom's tools. This is the current pattern, and somehow PCE has cut across core CPI. And the last time this happened, I'm not saying that this is set in stone, but the last time this happened, inflation soared. This is in the pandemic. And last time the time it happened before again was also a early inflation signal. Actually, it topped out soon after that. So I am on alert. And PCE is back at 3%, means that the Fed is definitely going to be very nervous about cutting rates anytime soon, particularly if PCE is going to continue going higher. And you can see that at best, PCE has bottomed out. I'll be writing about this on my Inflation Watch blog, because I think this is an important thing for both traders and investors to keep an eye on. Yes, core PCI might be coming down, but I'll write about why the Fed prefers PCE for guiding monetary policy. Okay, let's get into the charts for real. Let's start off by looking at market breadth, my favorite technical indicator, the percentage stocks trading above their 50-day moving averages, what I like to call AT50 for above the 50. We had one good up day in the week earlier. for AT50, and then we just had thrashing for the rest of the way. Net, I'd say nothing has changed one bit for market breadth. It's still in this danger zone, closed at 56.4%, but is still, in this general area of thrashing around. And I'm waving my cursor around, so if you can see that. Let's take a look at AT200, which is the percentage stocks trading above their 200-day moving averages. You can see the same thing. It's just thrashing around. Had that one good up day on Tuesday. For AT50, AT200 actually was Wednesday, and then it thrashed around. I think that's the same thing for AT50. So sorry, I got the days wrong. And it closed at 60.5%. But remember what I said earlier is that I'm afraid that this longer term measure market breadth is getting a little bit tired. And I'm starting to see a downtrend starting to weigh on this thing, a new downtrend starting to weigh on this thing. So that's what's making me wary. Let's also take a look at the VIX really quickly. I didn't mention this earlier, but as you know, I'm monitoring this overall sneaky uptrend. And look, the uptrend is still in place. Let me get that going. Yep. Still in place. And the VIX actually closed the week hovering above that. So in previous weeks, we've been tagging this line and then popping. This week, despite just the thrashing around, the VIX never quite got back to that line. That's interesting. That's very surprising. Let me pull this back since this was tariff day today with the Supreme Court. You can see here that I just want to do the reminder of what this horizontal line is. It's the pivot line that dates all the way back to when the VIX soared off of the April tariff drama, trauma, and noise. So the VIX closed the week at 19.1, and it thrashed too, but not quite as much as I think I would have expected. So anyway, that's the VIX. Now let's go to the S&P 500. Not a lot. Sorry. It seems like not a lot changed, but I was very curious, and sorry I didn't mark this. This should be the tariff decision day label here. The S&P 500, as far as I kept checking on it, it barely moved at all before or after the Supreme Court's decision. It ended up 0.7% on the day. Let's just zoom in here so you can see it tagged right at the 20-day moving average resistance, which is that dash line, and right above the 50-day moving average. So buyers are slowly but surely trying to keep intact the typical pattern, which is if you buy a 50-day moving average breakdown, you will make money in short order. So if you happen to get lucky enough but if you happen to get lucky enough to buy the very bottom, you're definitely well in the green. And if you bought anywhere on that breakdown, you're in the green. So in that sense, the typical pattern, I guess, is held up. Let's take a look at the 15-minute chart, because I just want to see what happened in the close. So you can see here, there was some inter-day thrashing around, then one big buying surge in midday, and then just sort of a drift higher into the close. Okay, I just wanted to make sure there wasn't like some weird surge towards the very end there. All right, NASDAQ was the same thing as the S&P 500. I didn't see much movement at all, but it did end the day relatively strong. Now its 20-day moving average is pointing down, so the onus is shifting more and more to the bulls to keep the NASDAQ from breaking down. I still think a test of this 200-day moving average, which is the blue line, is overdue. But, the buyers are hanging in there. Like I said, I don't expect much movement in the coming week just because of the State of the Union addresses. I don't think they're going to be an occasion for any kind of big sell-off. IWM, the small caps, also, this was even more of a boring week for the small caps. iShares Russell 2000 ETF. I mean, it pretty much closed flat on the entire week. I mean, you could see just a lot of thrashing up and down, up and down, up and down. The only time I had an opportunity to buy, my typical call options was if I had been astute enough on Tuesday to buy at the intraday lows, but I didn't have anything in place to buy any call options on an approach to the 50-day moving average support. But, despite the thrashing, the overall message is the IWM remains bullish, whereas the other indices are bearish, with the S&P 500, of course, starting to repair itself. All right, since this was tariff day, I am going to start with XRT, the State Street Spider S&P 500 S&P Retail ETF. It was basically a tariff showdown day for the XRT. You could see you may be wondering, well, why wasn't there a bigger reaction overall on tariff sensitive stocks? Well, the thing is, we have been talking about this tariff decision from the Supreme Court for so long, and the prediction markets nailed the odds to say that it was the Supreme Court was likely to rule against the administration. So none of this came as a surprise, and the administration's response is not a surprise because we knew that. And I forgot to mention this in the intro. Trump immediately responded by putting out a 10% tariff across the globe. And there are going to be some other authorizations that the administration is going to use to keep tariffs going. And again, that's not a surprise because there's been plenty of talk about what the options would be for the administration. So I just want to do the 15-minute chart on XRT just to show what happened. Again, I think most of this has the signature of algorithmic trading. You can see XRT soared at the open because we got that decision near the open. And it's hard to see that line, but XRT soared all the way to 90. And then in that same 15-minute bar, faded right back down to, let's just say, 88.87. And then the sellers took over for the rest of the day. And I expected a fade, but not instantly. And I certainly didn't expect sellers to be able to take XRT into a negative territory. So around this point, I can't remember exactly where, I went in and speculated on one single call option. I think it's a March 90, 80, yeah, 90 $90 strike call option. And I'll just see what happens from there because I just think that the bias is probably going to be up, particularly after seeing the sellers stop cold right under the 50-day moving average. Just hoping that XRT doesn't thrash a lot because if I pull back, you can see XRT hasn't gone anywhere much since September. It did briefly get a 4-year high earlier this year, and then sellers took XRT right back down. All right, let's keep it going with the tariff showdown stocks. Nike, big retailer, as we know, big shoe retailer. This was an even more important knee-jerk reaction and tariff showdown type of action because Nike's surge at the open took it well above the 200-day moving average resistance, which was an important breakout for a stock that's been downtrending. And only recently has this 200-day moving average been pointing up. Unfortunately, sellers took it back down, tapped the 50-day moving average, and it bounced back up. On balance, is basically a stalemate between buyers and sellers on Nike. And I can imagine why, because it was good that the news, the tariffs were going to likely go away. But then, of course, reality hits. And to say that, well, probably not a lot is going to change. And the market really wasn't reacting to tariffs much before this anyway. Dollar Tree is another stock that I did act on. I wrote about this. I think I talked about it much earlier. This was a trade that worked out. I held despite this 50-day moving average breakdown. And then when I saw the fade from above the the Bollinger Band, which is again the definition of about 80% of expected price volatility, I went ahead and sold because it's in an extended position, and I'll just be looking out for an opportunity to buy Dollar Tree again on the dips. So let me just wave my cursor here so you know what action I'm talking about. Okay, next up, we have Amazon. Now, Amazon's tricky to say that it's a tariff play. I think overall it's going to benefit from less or lower tariffs. And you can see all week long, Amazon is pretty strong. But of course, it came into this week having sold down and probably overdone to the downside. So there's a lot of pent up demand. I bought into Amazon's 6% earnings drop, even though it's in bearish position. If I pull back, you can see here. It's below the 50-day moving average and the 200-day moving average, so technically it's in bearish position. But for a long-term hold and investment, I had no problem buying here because I think this selling was overdone for Amazon.com, ticker symbol AMZN. All right, next up, the big news. I think this came towards I think it was earlier in the week. Earlier in the day. Anthropic, once again, is the culprit. It rolled out some product feature or something like that that allows coders, actually, I think it's a research tool even, allows coders to scan for malicious code in a code base or anything with security vulnerabilities. Now, I'm not a developer, but I'm not going to trust AI coming from the likes of OpenAI or Anthropic to scan my code for problems. There's just too much at risk. So I looked at, so you can take a look at the impact. This is HACK. It's an ETF. It's the Amplify Cybersecurity ETF. Plunged, well, it didn't really plunge, dropped 3.1%. I thought it would be a lot worse because it didn't even close below the low from earlier this month. So you have to look, you can see HACK is in an overall downtrend, and I think this is related to the SaaS apocalypse, but I didn't want to believe it because I'm thinking cybersecurity software stocks should be pretty immune to this AI panic that's going on, but it looks like it's not. You can see the impact even more prominently in select cybersecurity stocks. Okta, ticker symbol OKTA, is one that I happen to own. And it fell 9.2%. It dropped to a new, let's see, it came all the way back. Yeah, a new like 16, 17-month low. So that's pretty bad. But if I pull back, Okta really hasn't been going anywhere ever since it fell off that tech bubble top at 2021. So I've been sitting in it and just selling calls against the position, and it's been a trade that's worked out pretty well. But now with Okta at 17-month lows or whatever, I can't really sell any calls. So I just have to sit back and wait for the next recovery in this stock. Again, if I pull back here, you can see over multiple months, it's just been going nowhere. And that's why I'm assuming it's going to come back at some point soon. Now, next up, GoDaddy. I'm pulling this one up just because of the pattern. GoDaddy is ticker symbol GDDY. They do domains and websites. And this is the oddest chart I've seen in a while. You could see since 2018 all the way to almost the end of 2023, so about five and a half years, this stock literally went nowhere. I mean, you can't find better stocks that stay in a tight range over so many years. And then it just went ballistic all the way to what was this, a double? No, triple in about a year's time, a little over a year. And then just as fast as it went up, it's gone down. And now I think the AI panic has caused the selling to accelerate. I'll be very interested in seeing what happens to GoDaddy in earnings. It looks like earnings is next week. That's ticker symbol GDDY. Since we're talking about AI, here's a check-in on my favorite AI-related stock. It's Vertiv Holdings, ticker symbol VRT. Had a fantastic earnings last week, or I should say the previous week, up 24.5%. Typically, this is where I might just go ahead and close out a position, but the momentum looks good. The fundamentals remain good for Vertiv, so I'm just going to continue to hold my position. It's my favorite AI stock of all. I was very fortunate that I was astute enough to buy way down here during the tariff drama, trauma, and noise last April. Another AI-related stock is not doing so well. It's actually been sagging since an all-time high of back in December, and what was this, November. It's been sagging ever since then. Just as a reminder, this was a stock that I called out a while ago for a nice breakout, and I took profit somewhere along here, much too prematurely. I didn't appreciate what I had in hand, and now I've just been continuing to watch for a new entry point, but unfortunately, the stock looks like it's kind of topping out. In fact, if I draw one of my typical arcs, or just call it a curve, let's just make this plain. So you can see what I'm talking about is you can see this rounded top here, right? The sellers are, the buyers are running out of steam. And if I pull back, you can see that topping cone. And that's accentuated by the fact that there's now this pivot around the 200-day moving average, which is the blue line. Credo Technology Group, ticker symbol CRDO, has a now 50-day moving average that's downtrending. So this is a stock in trouble from a technical standpoint. So I'm just going to sit back and wait until earnings and see what happens next on Credo Technology Group, ticker symbol CRDO. It's another AI play. I think they build connectors for data centers. Don't quote me on that, but that's my memory. Okay, Oklo. I haven't looked at this one ever, I think, in my blog or in the video. I'm pulling this up just because the news about alternative power sources. Oklo makes nuclear minute. I think they're called mobile nuclear reactors or compact nuclear reactors, something like that. I haven't really seen any news about this. This stock had a lot of hype. Let me just show a reminder. This was a SPAC, I believe. So it was around $10. It dropped. And then after the election, it just soared as it looked like regulatory hurdles would get out of its way. But this is a company that makes no money as far as I can remember. It doesn't have any revenue. So it's essentially an R&D stock. And it can just trade up or down for whatever reason. And now it looks like the buyers have lost their enthusiasm. You can see it topped out in October and it's just been sagging ever since. The technicals have really defined most of the trading. You can see, I'm just going to scroll back here so you can see like this neat tag of the 200-day moving average support was a buy signal. The breakout over 50-day moving average is a buy signal. Tapping the 50-day moving average here was another buy signal. This was support. And now all of these bullish signals are being replaced by bearish signals. So you can see this 50-day moving average breakdown. Oklo has not recovered from that. It couldn't break through resistance here. It did bounce off 200-day moving average support. So this was a brief bullish signal, and then it broke out above the 50-day moving average. And this is actually where it caught my attention and I got faked out. In fact, I closed out all of my Oklo just today, just took the loss because of this bearish reversal from the breakout, which makes it a fake out to a 50-day moving average breakdown, 200-day moving average breakdown. And now I really don't like what's happening today. It looks ready to break down, to do a fresh breakdown. So yeah, that was a lot of words just to say that Oklo just doesn't look good to me from a technical standpoint, and I don't see a reason to get back in anytime soon until I can see a sustained and convincing breakout like it used to do back when it was in bullish position. All right, speaking of bearish, this is ticker symbol CAR. This is Avis Budget Group. They do car rentals. This is another one of these cautionary tales about a downtrend. You can see CAR had a very bad earnings report last summer, came down 15%, and it hasn't recovered ever since. It's just been drifting downwards. And finally, it gave up the ghost yesterday for a 21.5% post-earnings loss. Now you can see these candles. Let's just zoom in here. You can see these candles. The buyers are trying to step in at the lows and save the stock. So it may have a nice rebound to play, but I'm not interested in it that way at all. In fact, if I could catch it on a fade, I might dare to short it. But you didn't hear that here. Oh, and by the way, all of this is for informational purposes. Please trade and invest according to your own risk tolerances and risk preferences and your time horizons. All right, last stock, also bearish. This is ticker symbol EAT for Brinker International. It's one that I have been in and out of. The last trade was not successful, but I've just been a skeptic of how this stock has been holding up. You can see it's had a nice run since the bear market. Tremendous run. It's strange for a casual food restaurant to do something like this. It's topped out on a double top that's been in place since 2025. That's added to my skepticism, and the stock has not recovered yet from this double top at the all-time high. And now it looks like it's losing steam again. It's below both its 50-day moving average and its 200-day moving average, which makes it definitively bearish. So it's on my short list, not on my bullish list. And even when buying signals come up, I don't think there's much upside here to be had. All right. So thanks for sticking in with me. Thanks for checking this out. I will remind you to like and share this content so the algorithm knows what's up. Comments or feedback, put them down below. And of course, subscribe to the channel so that you can get alerted when fresh content comes out. All right. Have a good one, everybody. And thanks for